Welcome to the Deep Dive. Today we're pulling back the curtain on a company that's, well, literally reshaping how surgeons operate and how patients recover. Stryker Corporation, SYK for short. This isn't just about understanding a business, It's about really dissecting a vital innovator in the healthcare space, exploring how it's built to last, and appreciating the often complex world of high technology medicine. Our mission with this discussion is to really unpack Stryker. We'll look at its business quality, its competitive advantages, how its management steers the ship, its financial resilience, and what its future truly looks like. The core question for us and for you to maybe chew on as we go is this. Is Stryker genuinely a wonderful company? And if it is, does its current market valuation make it a wonderful investment right now? Let's get right into it.
So, let's start with the absolute basics. What is Stryker really all about at its core? How does this foundational business actually, operate day to day?
Right. Well, at its heart, Stryker's business model is surprisingly straightforward, actually. And that simplicity, combined with its vital role, is one of its enduring strengths. They design, manufacture, and then they directly sell high-technology medical devices, implants, and various pieces of equipment. Pretty simple on the surface, their primary customers. It's hospitals, surgeons, and other healthcare facilities all around the world who really depend on these tools for procedures. As of their 2024 fiscal year, their operations are mostly structured into two key segments. The first, and currently the larger one, is MedSurg and Neurotechnology. This segment brought in, a substantial 59.8% of their global sales. It covers an incredibly wide array of products. Everything from intricate surgical instruments used in operating rooms to highly specialized neurovascular devices for treating strokes. It's quite broad. The remaining 40.2% of their revenue comes from their orthopedic segment. This is probably what most people instinctively think of when they hear the name Stryker. Joint replacements like hip and knee implants and devices for fixing trauma like broken bones.
Okay, that's a clear breakdown of what they sell. But how do they actually generate their revenue? Is it just a one-time product sale? Or, as you kind of hinted, are there recurring elements? Things that contribute to a more stable, predictable income stream?
That's a really crucial distinction. And the answer is absolutely yes. There are significant recurring elements. Big time. While direct product sales are, the primary engine, think those orthopedic implants for hip and knee replacements, trauma fixation devices for broken bones, advanced surgical navigation systems, endoscopic cameras for minimally invasive procedures, or even specialized hospital beds and cutting-edge neurovascular devices for stroke treatment. What really strengthens their model is the growing stream of recurring revenue. This comes from things like equipment maintenance and support contracts. That's a big one.
Okay.
For instance, in 2023 alone, those services generated over $673 million in revenue. So it's not trivial. They also provide consulting services, helping hospitals optimize their workflows, which is increasingly important. And they even offer remanufactured medical devices.
Remanufactured, how does that fit in?
Well, these options are often more cost-effective and, importantly, sustainable for healthcare providers. And crucially, they build really sticky long-term relationships because Stryker is offering ongoing value beyond just the initial purchase. It keeps them embedded.
It really sounds like a business built for the long haul then.
Yeah.
What makes this model so fundamentally durable? It feels like it's highly likely to remain relevant for decades, right? What are the powerful, almost undeniable trends underpinning this endurance?
It really is built for longevity. And it's anchored by these incredibly powerful, non-cyclical, and frankly, deeply human trends. Firstly, and perhaps most impactful, is the aging global population. This is a demographic tailwind of, epic proportions.
Right, we hear about that a lot.
Exactly. As people live longer lives, they inevitably face a higher incidence of age-related conditions, like osteoarthritis, osteoporosis, stroke. The list goes on. The demand for interventions addressing these conditions is only going to grow structurally for, decades to come. It's baked in. Secondly, you have the fundamental human desire for a higher quality of life. It sounds simple, but it's powerful.
Sure.
We all want to maintain our mobility, our independence, and find effective treatment for debilitating conditions that impair our daily lives. This means that spending on these medical interventions isn't really a luxury item, is it? For patients and healthcare systems alike, it's largely non-discretionary.
Yeah, if you need a hip replacement to walk without pain, you're getting that hip replacement.
Precisely. It's not an optional purchase. And finally, there's the relentless, perpetual pursuit of better clinical outcomes through technological advancement. This fuels a continuous cycle of innovation and demand. Stryker, which interestingly was founded way back in 1941 by an orthopedic surgeon, they have a long, impressive history of leading this cycle.
Wow, 1941.
Yeah. deep roots. They're deep and consistent investment in areas like robotics, AI-driven surgical planning, and minimally invasive techniques ensures their continued relevance. And crucially, this innovation allows them to command premium pricing because they aren't just selling a product. They're consistently elevating the standard of care and delivering truly better health outcomes. So a powerful combination, really.
So the durability feels baked in, but what seems really transformative about Stryker's approach now is how they're evolving beyond just selling individual items. It feels like they're not just selling products anymore, but entire solutions for the operating room. Can you elaborate on that shift? Why is that so fundamental to their future?
That's an absolutely critical observation. Spot on. And it speaks directly to their long-term strategy and where they see the future. Historically, yeah, they were selling discrete items. You buy an implant here, a surgical saw there, piece by piece. But the acquisition and subsequent expansion of the Mako robotic platform completely reshaped this. Mako isn't just another product they sell. It's a foundational capital equipment platform.
A platform, okay.
Exactly. And it creates what we call a captive ecosystem. Once a hospital invests in a Mako robot, it's not just for a single procedure. That robot explicitly requires the use of Stryker's specific proprietary implants and its specialized software for every single procedure performed with it.
Every procedure.
Every single one using Mako. This creates an immediate and powerful dependency. It's locked in. And they've further deepened this integration by bringing in digital health technologies like those from their Vosera communications acquisition. Vosera provides clinical communication platforms within hospitals, streamlining things, and they've layered on AI-powered preoperative planning software such as Blueprint.
So it connects everything.
Exactly. So what this means is that Stryker is moving far beyond just providing a thing. They're providing a comprehensive, interconnected workflow solution. It integrates into the entire operating room, often connecting to the hospital's broader digital infrastructure. This transition from being just a product vendor to a platform provider dramatically increases customer stickiness. It just makes it harder to leave. It generates a powerful, self-reinforcing flywheel of recurring revenue from all those consumables and services tied to the Mako platform. And, perhaps most importantly, it erects a far, far more formidable competitive barrier than any single product could ever achieve on its own. It's a strategic masterstroke, really, and it's absolutely central to the business's long-term durability and its ability to keep leading the market.
That makes total sense. So with this platform strategy really taking hold, what makes them so tough to compete against? How wide and deep is their fortress, their economic moat, really?
Their competitive fortress is remarkably wide and deep. Primarily, it stems from what we identify as high switching costs for their core customers, the hospitals and surgeons. These costs are then significantly reinforced by substantial intangible assets, think brand, patents, and powerful scale advantages. To give you a concrete example, let's look inside their Orthopedics division. An orthopedic surgeon's specific skill and their extensive experience with a particular set of instruments and implants. Well, that plays an outsized role in the clinical outcome for the patient.
Right. The surgeon's technique matters hugely.
Hugely. This isn't just about comfort. It's about precision, muscle memory, years of practice, ensuring the best possible result. Because of this, surgeons are profoundly reluctant to go through the arduous process of training and mastering multiple instrumentation systems. The cost of switching isn't just financial. It involves a significant investment of their time, their effort, and crucially, it introduces an element of risk into procedures where precision is absolutely paramount. That creates a powerful inertia, a resistance to change that strongly favors the incumbent, which, in many key areas like knees, is Stryker.
That makes perfect sense. So let's drill down specifically on Mako then. You mentioned it creates a multi-layered lock-in. What makes that system so formidable? Why is it such a nightmare for competitors to try and penetrate?
Mako is arguably the crown jewel of their Moat trilogy right now. It creates this incredible multi-layered lock-in that makes it exceptionally difficult for anyone else to compete effectively. Firstly, the hospital itself makes a substantial capital expenditure. We're talking often exceeding $1 million just to acquire a Mako robot.
$1 million up front. Wow.
Yeah, that's a huge immovable investment right there. It anchors them. Secondly, once that robot is in place, the hospital's orthopedic surgeons then invest hundreds of hours in training. This isn't a weekend course.
Hundreds of hours.
Hundreds. They master the Mako system software, its unique haptic feedback. That's the tactile sensation the surgeon feels through the robot, guiding their cuts with extreme precision and the entire, very specific procedural workflow. This learned skill becomes a valuable personal asset to the surgeon, something they've poured immense time and effort into perfecting. They own that skill. And thirdly, the Mako system is deliberately, intentionally designed as a closed ecosystem. It's meticulously optimized to work only with Stryker's proprietary implants and its AI-driven surgical planning software.
Only Stryker stuff works with it.
Exactly. You simply cannot plug in a competitor's knee implant or use another company's planning software and expect it to work seamlessly, let alone deliver the same kind of precision and predictable outcomes. It just won't happen.
So, if we put all of that together, what does that Mako dynamic really mean for a competitor? It sounds like it just actively repels them, almost pushes them away.
That's a great way to put it. It actively repels them. Imagine a competitor like, say, Zimmer Biomet. They can't just walk in and say, hey, hospital, hey, surgeons, we've got a slightly cheaper knee implant.
Yeah.
That offer is almost irrelevant in a Mako hospital.
Why is that?
Because first, they have to convince the hospital administration to essentially write off its multi-million-dollar capital investment in the Mako robot. That's a non-starter in most cases. And even more dauntingly, they have to persuade the surgeons who have invested those hundreds of hours mastering the Mako system to abandon their hard-won expertise, their comfort, their confidence in that system, and embark on an entirely new, potentially risky learning curve with a completely different robotic system or workflow.
That's a huge ask.
It's a massive ask. The switching costs are astronomical and multifaceted: financial, time, training, clinical risk. This Mako ecosystem actively repels competitors, and that is what allows Stryker to maintain exceptional pricing discipline on its high-margin implants, because they know it's incredibly difficult for customers to leave once they're inside that Mako orbit.
Okay, so Mako is clearly huge. Beyond Mako, though, what other competitive advantages buttress this primary moat? What makes the fortress even stronger?
Well, there are several other important factors, all contributing to that deep fortress. They possess significant intangible assets. We're talking about a globally recognized brand that has been trusted by surgeons for, well, decades now. That kind of reputation isn't built overnight. It's earned over time through consistent quality and support.
Trust is key in medicine.
Absolutely paramount. Alongside that brand trust, they hold a vast portfolio of over 14,200 patents. These patents are crucial legally. They protect your innovations from being easily copied by rivals, giving them exclusive rights to their cutting-edge designs and technologies for a long time. Then there's their clear technological leadership. Stryker has consistently pushed the boundaries, especially in areas like additive manufacturing or 3D printing for implants.
3D printed implants.
Exactly. Their tritanium technology, for example, allows them to create implants with intricate, porous structures that are clinically superior because they encourage better bone integration, better ingrowth. These are incredibly difficult for competitors to replicate without infringing on patents or investing massive amounts in R&D just to try and catch up. And finally, you can't ignore their scale advantages. As a market leader, remember that estimate? About 34.3% share of the U.S. orthopedic products manufacturing industry back in 2021. Stryker benefits from massive economies of scale that smaller rivals simply can't match.
How does that scale help specifically?
Think about the efficiencies in their manufacturing processes, the sheer reach and cost-effectiveness of their global distribution network, and, critically, the enormous amounts they can pour into research and development. Their R&D budget alone dwarfs that of many of their smaller competitors, allowing them to innovate faster across more areas and stay ahead of the curve.
So this moat sounds incredibly strong, almost impenetrable. But is it static, or is it actually getting stronger over time? What's its trajectory looking forward?
This is where it gets really interesting, I think. The trajectory of this moat is clearly, demonstrably widening. It's not staying still, it's expanding. The most compelling evidence for this is the ongoing expansion of the Mako robotic platform itself. It started very successfully with specific applications like total knee and total hip replacements. But now they're strategically moving it into new, equally large, and potentially even more complex and lucrative markets like spine surgery and shoulder surgery.
So applying the same robotic precision to backs and shoulders.
Yep. Exactly. Each new anatomical application approved for Mako and the necessary FDA approvals are absolutely key milestones here. Significantly increases the value of that initial capital investment for the hospital. Makes the robot more versatile, more utilized. It further embeds the system into the hospital operational core, making a switch to any competitor, even for just one type of procedure, even more costly, disruptive, and frankly just illogical from the hospital's perspective. It's a powerful, self-reinforcing loop. Every new Mako application tightens Stryker's grip.
This leads to a fascinating evolution of the moat itself, doesn't it? It seems to be shifting from primarily being maybe surgeon-centric, tied to one doctor's preference, to becoming truly institution-centric. How does that enhance its durability in the long run?
That's a brilliant insight, and it's absolutely crucial for understanding the long-term strength and stickiness here. The traditional moat, you could argue, was often anchored to an individual surgeon's training, their muscle memory, and their personal preference for a specific tool or implant brand. While powerful, that link could theoretically be broken if, say, a key surgeon retired or moved to a different hospital that didn't have that specific system, or simply got wooed away by a competitor's new gadget.
Right, it was tied to the person.
Exactly. But the Mako ecosystem fundamentally changes this dynamic. It creates true institutional lock-in. Remember, the hospital itself makes a significant capital investment in the robot, not just an individual surgeon footing the bill. And the Mako system integrates with the hospital's broader digital infrastructure, a trend that's been accelerated by strategic acquisitions like Vosera, which provides those clinical communication platforms that streamline hospital-wide operations. So the hospital administration benefits directly from this institutional commitment. They see standardized procedures across surgeons, which improves efficiency. They see improved patient outcomes, which positively impact their reimbursement rates from insurers and their public quality ratings. And they see greater overall operational efficiency across multiple departments using the same core platform.
So the benefits go way beyond just one surgeon or one department.
Way beyond. As a result, the decision to switch away from Stryker products, especially Mako and its associated implants, is no longer just the choice of one surgeon making a preference call. It becomes a major strategic, financial, and operational decision for the entire hospital C-suite. They've invested millions, they've trained multiple surgeons across different specialties, they've integrated into their IT systems, they're seeing system-wide benefits. Pulling that out becomes incredibly disruptive and expensive. This institutional entrenchment provides a far more permanent and durable competitive advantage. It's much harder to pull out an entire integrated system than it is to convince one surgeon to try a different screwdriver, so to speak.
Okay, that makes a lot of sense. It paints a picture of a very well-defended fortress. Let's shift our perspective a bit now and talk about what's happening, on the ground level. What's the scuttlebutt, the informal intelligence, the word on the street from end users and employees telling us about Stryker?
Right, let's start with the ultimate customer, the patient, the end beneficiary. When you look at their sentiment, especially from those who undergone Mako robotic arm-assisted surgeries, it is overwhelmingly positive. It's actually quite striking. If you browse online forums, read patient testimonials, or even just general reviews, they are filled with praise. Patients frequently describe their outcomes using terms like life-changing and truly wonderful.
Life-changing, wow.
Yeah, they highlight significant pain reduction, which is huge, and often a surprisingly rapid return to activities. They love things like tennis, golf, hiking, even more adventurous pursuits like kite surfing, which were previously impossible due to joint pain. On platforms like Reddit, you see specific discussions where patients who have had, say, Mako hip replacements often report very high levels of satisfaction. They note excellent results, impressively quick recovery times compared to traditional methods, and, importantly, the successful avoidance of common complications, like post-operative leg length discrepancy, which can be a real issue. This genuine patient satisfaction, this kind of customer love, is a powerful, albeit maybe unquantifiable, asset. It builds immense brand equity and reinforces the company's reputation for delivering real-world quality and tangibly improved lives. Surgeons notice this too, of course.
That paints a really compelling picture from the patient side. That's fantastic to hear, but I understand there's a pretty significant dichotomy when you look at the employee perspective, especially concerning their sales force. What's the contrast there? What's the other side of the coin?
You've hit on a really crucial and, frankly, fascinating point. There's a real split narrative here. Officially, and certainly in many public accolades and awards, Stryker's corporate culture is highly lauded. They are consistently recognized as a great place to work, which is not easy to achieve, and they actively promote a mission-driven environment that emphasizes developing their people. They even have a strategy they've dubbed talent offense, supported by respected partners like Gallup. That's the public, polished image. Yeah. And for many employees, especially perhaps those higher-ups or in certain corporate departments, it's very much their reality.
Okay, that's the official story. But if we look at, say, anonymous employee forums, maybe Glassdoor, or places frequented by their medical device sales representatives, what do we hear then? What's the grittier picture behind that official praise?
This is where the narrative becomes much more nuanced and, well, sometimes quite stark. Common themes that consistently emerge from these discussions, particularly from the sales side, include descriptions of a toxic, relentlessly high pressure, and sometimes cutthroat sales culture.
Toxic and cutthroat. That's strong language.
It is. Many reps report a severe lack of work-life balance, with some even detailing harrowing work weeks of 80 to 90 hours, especially when supporting surgeries. There are frequent complaints about compensation structures that are perceived as unfair, particularly to junior associates trying to break in, and a widespread sentiment of burnout is pretty common in these forums. A recurring piece of advice you see from current and former reps is quite telling. They often suggest joining Stryker primarily for the prestigious name on your resume to get that Stryker brand association, endure the difficult, demanding environment for maybe a year or two, learn a lot very quickly, and then leverage that experience to leave for a better, perhaps more balanced opportunity elsewhere. It's often framed as a high-intensity boot camp, but not necessarily a sustainable long-term career destination for many on the absolute front lines.
That's a tough environment, no doubt. So how does this high-pressure sales culture, this clear dichotomy we're seeing, act as a kind of double-edged sword for Stryker? It must drive results on one hand, but it sounds like it could create some real vulnerabilities too.
It absolutely is a double-edged sword. You've nailed it. On one side, it's highly likely a significant driver of the company's impressive market share gains and consistent, often aggressive, sales growth year after year. That intense focus on performance, on hitting targets, clearly delivers results. It pushes reps to work incredibly hard, cover more cases, and close deals to support surgeons effectively. That's the sharp edge that cuts through the competitive market.
Okay, so it works for growth?
It seems to, yes. However, the other edge is that it also represents a tangible potential long-term vulnerability. Think about it. The relationship between a surgeon and their specific device representative is a critical human-to-human component of that switching cost moat we discussed earlier.
Right, that personal connection.
Exactly. The rep isn't just a salesperson dropping off brochures. They are often a trusted technical expert right there in the operating room, providing real-time support during complex procedures, troubleshooting equipment, and educating the surgical team on new techniques or products. They build deep trust. So a culture that fosters high employee churn and widespread burnout among these critical frontline personnel risks fundamentally weakening these vital relationships over time. Every time an experienced, trusted Stryker rep, someone a surgeon relies on, leaves the company, it creates an opening for a competitor to swoop in, build a new relationship with that surgeon, and establish a new trusted point of contact. Now, while the institutional lock-in from the Mako platform provides a very strong backstop and is undeniably powerful, this human element of the moat could become brittle over time if the best, most experienced sales talent is consistently burning out and leaving after only a short tenure. The stark contrast between the polished corporate image and the challenging frontline reality is a key risk factor that definitely warrants ongoing monitoring for anyone looking at the company long-term.
That's a really fascinating contrast and a potential hidden risk. Let's zoom out a bit now, maybe go to the very top. How do we see Stryker's management team, currently led by Kevin Lobo, approaching leadership and, importantly, capital stewardship? Does it appear to be a disciplined approach to growth from the C-suite?
From everything we can observe, Kevin Lobo, who's provided over a decade of stable leadership, he's been CEO since October 2012 and chair since July 2014, which is significant tenure, has implemented and maintained a very consistent, disciplined, and clearly owner-oriented operating philosophy. If you look at his public statements, listen to earnings calls, and analyze the company's strategic actions over that period, they repeatedly articulate a very clear capital allocation strategy. Their number one priority, explicitly stated time and again, is value-accretive mergers and acquisitions, or M&A. That comes first.
M&A is priority one.
Priority one. This is followed by a strong commitment to paying and consistently growing the dividend for shareholders. And then, share repurchases are used opportunistically, not as a primary driver of returns or a way to just hit EPS targets. Lobo has publicly emphasized a focus on return on invested capital over time, which is exactly the language you want to hear from a long-term oriented CEO. It signals a clear preference for deals with strong strategic logic and real long-term potential over just short-term financial engineering or buying revenue for revenue's sake. It's a very rational, patient, long-term mindset that clearly aligns with building enduring shareholder value.
Okay, that's the philosophy. And what does their actual track record show us? Does their behavior over the past decade really match this stated philosophy? What's the evidence?
The evidence is abundant and remarkably consistent with that stated philosophy. Firstly, they consistently reinvest a substantial portion of their revenue right back into the core business through internal research and development. This fuels organic growth and keeps their product pipeline fresh. Historically, this R&D spend has been between 6% and 7% of sales, which is a healthy commitment. For instance, in fiscal year 2024, they invested a significant $1.5 billion in R&D on sales of $22.6 billion. That's a solid 6.6% reinvestment rate right back into innovation. This internal engine is crucial for developing their next-generation products and, importantly, for effectively complementing and integrating the technologies they bring in through those acquisitions.
Right. R&D supports the M&A.
Precisely. Speaking of acquisitions, M&A is clearly their primary use of capital, and they seem to treat it as a core competency, not just an occasional activity. Stryker has been a disciplined serial acquirer, executing more than 50 acquisitions just in the last decade alone.
50.
Yeah, it's a significant number. But their strategy here isn't random. It's not just buying anything. It appears highly focused on acquiring companies in high-growth adjacent markets like neurotechnology and spine, or companies with enabling technologies such as robotics, digital health, and AI things that strengthen and expand their existing ecosystem and moat. Think about the high-profile examples we know. Mako, surgical for robotics at $1.7 billion, which fundamentally transformed their orthopedic business. Wright Medical for extremities and upper limb at $4 billion, significantly expanding their orthopedic reach. Vosera Communications for digital health and communication platforms at $3.1 billion, deepening those institutional ties within hospitals. And the recently announced definitive agreement to acquire Inari Medical in peripheral vascular thrombosis for $4.9 billion, pushing them into new, adjacent, high-growth therapeutic areas.
So these aren't just small tuck-ins. These are major strategic moves.
Absolutely. This pattern clearly shows an intent to use M&A strategically to widen their moat, to build higher walls, not just to buy top-line revenue. It's a calculated strategy to add more layers to their competitive advantage over time. In terms of shareholder returns, management has shown a firm commitment there as well, consistent with their stated priorities. Dividends are treated as a reliable component of shareholder return and have been increased for an impressive 16 consecutive years.
16 years of increases. That's solid.
It shows commitment. The quarterly dividend, for example, was raised by a healthy 6.7% in late 2023, and CEO Kevin Lobo directly linked this increase to the company's strong underlying growth and their disciplined financial performance and capital allocation strategy. The annual dividend has grown steadily from $1.93 per share back in 2018 to a projected $3.36 per share for 2025. That's meaningful growth. Share repurchases, as mentioned, are used opportunistically rather than as a primary systematic tool to return capital. They maintain large authorizations like the $2 billion program announced back in 2015, but they seem to deploy capital into buybacks strategically, presumably when management believes the stock price is particularly attractive or when it's truly the most efficient use of capital compared to M&A or R&D. The relative infrequency of massive sustained buyback programs is actually, I think, a positive sign of discipline. It indicates a strong belief within management that reinvesting in the business through high-return M&A and internal R&D offers a superior long-term return for shareholders compared to just artificially boosting EPS through buybacks.
Okay, so putting it all together.
So all the evidence overwhelmingly points to a rational, consistent, and shareholder-friendly capital allocation framework. Reinvestment in the business seems logical given their deep pipeline of organic and inorganic growth opportunities. There's really no indication of reckless empire building for its own sake. Rather, the strategy appears calculated and focused on long-term value creation. In fact, I'd argue their M&A strategy is more than just a tool for revenue growth. It's a fundamental component of their moat-widening strategy. Each major acquisition, Mako, Wright, Vosera, and potentially Inari, brings a technology or market position that integrates with and strengthens Stryker's existing relationship with the hospital C-suite and operating room, making them more deeply embedded and indispensable to their customers. The capital allocated to M&A is therefore not just purchasing an income stream, it is purchasing additional layers of moat, systematically raising the switching costs for the entire institution over time. That's arguably a far more valuable and enduring use of capital than simply buying back shares without a clear, compelling strategic purpose. This clear strategic intent behind their capital allocation is really the sign of an exceptional management team at work.
It's compelling to see how those strategic decisions seem to directly reinforce the business quality and the moat. Let's dig into the numbers themselves now. How do these strong qualitative aspects, this disciplined stewardship you're describing, actually translate into the cold, hard financial performance? How robust is Stryker's financial fortress when you look at the results?
Stryker is really a paragon of financial consistency and strength. It's quite remarkable. For over 3 decades, they have delivered uninterrupted annual sales growth. Let that sink in over 30 years without a down year in sales. That's an absolutely incredible achievement in any industry, let alone the complex, dynamic, and sometimes cyclical healthcare sector.
30 years is amazing consistency.
It really is. And this consistency isn't just some historical artifact. It's profoundly evident in their most recent results as well. Net sales grew strongly from $18.4 billion in 2022 to $22.6 billion in 2024. That represents a compound annual growth rate, or CAGR, of over 10% during that period. And this robust top-line growth reliably translates down the income statement into profit. Net earnings have steadily marched upward alongside sales, demonstrating that the business is a powerful and predictable earnings machine. This long track record provides a high degree of confidence in their ability to navigate economic cycles and industry shifts, consistently generating value year after year.
That sustained growth is certainly impressive. Let's dive into some of those key financial quality ratios we often look at. What does return on invested capital, or ROIC, tell us about the fundamental quality of the business? How good are they at deploying capital?
Right, ROIC is arguably the single most important metric for assessing the true underlying quality of a business. It measures how efficiently management allocates its entire capital base, that includes both debt and equity, to generate profits. It tells you if they're earning more than their cost of capital. And Stryker has consistently generated high double-digit returns on invested capital. Over the last 5 years, their ROIC has averaged a very healthy 11.2%. It even reached 12.8% in the most recent fiscal year.
And how does that compare to their cost of capital?
That level of return is comfortably significantly above their estimated weighted average cost of capital, or WACC, which is the minimum return they need to earn to justify their investments and create value. So this provides direct quantitative proof that the company is creating significant economic value, true economic profit, above and beyond its cost of funding. Now, it's worth noting, as we touched on, that ROIC can be temporarily depressed right after large, goodwill-heavy acquisitions. When you pay a big premium over book value, that goodwill inflates the invested capital part of the ROIC calculation initially.
Right, the denominator gets bigger instantly.
Exactly. But Stryker's resilience in bringing that ROIC back up post-deal, historically, has really validated management's focus on achieving those long-term high returns from the investments they make. It shows the acquisitions generally work out over time.
Okay, that makes sense. And how about free cash flow, or FCF conversion? What does that signal about the quality of their reported earnings? Does their reported profit actually turn into real, spendable cash?
FCF conversion measures precisely that. How effectively a company's reported net income, the bottom line on the income statement, is converted into actual free cash flow, the cash available to its owners after all necessary business investments have been made. A consistently high FCF to net income ratio indicates strong working capital management, efficient operations, and critically, high-quality profits that aren't just accounting entries, but represent real cash generation. Stryker has demonstrated solid, though sometimes variable, cash conversion over the past 5 years. There was a noticeable dip in 2022, which was likely due to increased post-pandemic supply chain investments and maybe some working capital buildup as things normalized.
Okay, so a temporary blip, perhaps.
Seems like it, because we saw a strong rebound to 81% conversion in 2023, and then an impressive 107% conversion in 2024. So they actually generated more free cash flow than net income last year. This variability is somewhat typical for companies making large investments or acquisitions, but the strong underlying trend of the powerful rebound prove the fundamental cash generative power and the overall health of their business model. The earnings quality looks solid.
Good to see that cash flow strength. And finally, looking at their balance sheet, you mentioned the acquisitions. Are they prudent stewards of their debt? Do they take on too much leverage to fund this M&A strategy?
Based on their history and current position, yes, management has proven to be incredibly prudent stewards of the balance sheet. They absolutely use leverage strategically to fund those value-creating acquisitions we discussed. It's often cheaper than equity. But it's always managed with what appears to be impressive discipline. For instance, after the significant debt-financed acquisition of Vosera Communications, their leverage, often measured as net debt relative to EBITDA, earnings before interest, taxes, depreciation, and amortization, was expected to rise temporarily to around 2.9 times. That's getting up there, but still manageable.
Okay, 2.9x. And where did it end up?
Well, thanks to their strong cash flow generation and a focus on rapid deleveraging after the deal closed, S&P Global, the credit rating agency, forecasted that leverage would decline pretty quickly back down to a very comfortable level of approximately 1.7 times by the end of 2024. That 1.7x level is well within typical investment-grade parameters and clearly demonstrates a commitment to maintaining strong financial flexibility and a significant margin of safety against any unforeseen adversity or downturns. They don't seem to let leverage get out of control. So if we quickly recap those 5-year trends we have, revenue climbed consistently from $14.4 billion in 2020 to $22.6 billion in 2024. Net income grew nicely from $1.8 billion to $3.0 billion in that same period. ROIC steadily improved from 9.7% to 12.8%, showing increasing capital efficiency even with acquisitions. Leveraged free cash flow moved up from $2.3 billion to $3.2 billion. Their FCF to net income ratio, while fluctuating a bit, landed at that strong 107% in 2024. And importantly, their net debt to EBIT, after peaking around major deals, is forecasted to be down at that very manageable 1.7 times level. The financial health looks robust. It's worth just reiterating that inherent tension, though, where large acquisitions bring significant goodwill onto the balance sheet, temporarily depressing the calculated ROIC. The crucial test, always, is successful integration to lift that consolidated ROIC back to high levels over the next few years, proving the acquired assets are genuinely value accretive and were worth the premium paid. Stryker's track record, looking back, shows they've been remarkably successful in achieving this post-acquisition synergy and value creation. So naturally, monitoring the ROIC trajectory in the 2 to 3 years following the large, pending Inari medical acquisition will be the next key test of this critical capability for management.
Okay, so we've built a pretty compelling case, I think, for Stryker being a truly high-quality enterprise, strong business model, wide and widening moat, managed by a disciplined team with a robust financial fortress. But this is where the rubber really meets the road for us and for you, the listener, as potential investors. What are we actually paying for all that quality right now? Does the current stock price offer an attractive entry point, or are we paying nosebleed levels?
Yeah, that's the million-dollar question, isn't it? Or maybe the multi-billion-dollar question in Stryker's case. As of early July 2025, when we're looking at this, Stryker's valuation is, well, simply put, it's elevated. It's rich. If you look at its price to earnings, or PE, ratio on a trailing 12-month basis, TTM, it's sitting at approximately 52.7 times based on GAAP earnings. That's a big number.
52.7 times earnings. Oof.
Yeah. And its price to free cash flow, or PFCF ratio, which, as we discussed, arguably gives us a truer picture of cash generation available to shareholders, is also quite high at around 42.6 times on a trailing basis.
So high multiples on both earnings and cash flow. How do those numbers stack up against Stryker's own historical valuation multiples? Are they just high relative to the market or high even for them?
That's the key comparison. And yes, they definitely indicate a significant premium compared to their own history. The current trailing PE of about 52.7 times is substantially higher than its 5-year historical average PE, which was already pretty high at approximately 45 times. And it's even more pronounced when you look further back at its 10-year historical average PE, which was closer to around 39 times. So the market is currently assigning a notably higher multiple to Stryker's earnings and cash flows than it has on average over the last 5 or even 10 years.
Okay, so definitely trading above its own historical averages.
Absolutely. So the crucial judgment here, the takeaway, is quite clear. Stryker is undeniably a wonderful company. We've established that, I think, through our analysis of its robust business quality, its formidable and widening moat, and its excellent disciplined management team. No debate there. However, the market is fully aware of this quality. This isn't some hidden gem, and it has priced the stock accordingly, maybe even enthusiastically. The current valuation represents a demanding entry point.
Demanding is a good word for it.
It really is. It's not a bargain by any stretch of the imagination, and it clearly reflects very high expectations baked into the price for future growth and continued flawless execution. An investment at these current levels implies paying a steep premium for excellence. While the business itself feels exceptionally safe and high quality, the current valuation offers a pretty low margin of safety on the price you're paying for that quality. As an investor today, you're essentially paying a full, perhaps even a premium price for a best-in-class enterprise. And that requires really strong conviction in the long-term growth thesis to justify paying up this much.
That makes the investment decision a lot harder, doesn't it? Even for a demonstrably great company. So, given that high price, what is the big growth story going forward? Where are they placing their biggest bets? What needs to happen to justify that valuation?
Right, what drives the growth from here. The primary engine for Stryker's future earnings growth, the one that really stands out above all others and likely underpins those high expectations, is the successful expansion of its flagship Mako robotic platform into new, large-scale surgical markets. We're talking specifically about spine surgery and shoulder surgery, coupled with its continued international penetration where robotic adoption often lags the U.S.
Spine and shoulder. Okay. How's that progressing?
It's not just a hopeful bet on the horizon. We've already seen the first Mako spine cases being performed in late 2024, apparently with very positive initial surgeon feedback. And Mako shoulder received its crucial FDA approval around that same time frame, so the rollout is underway. This strategic move, if successful, creates a powerful and highly profitable growth flywheel. Remember how it works. The initial capital sale of the robotic system, that multi-million-dollar investment by the hospital, then drives a long-term, high-margin recurring revenue stream from the proprietary single-use implants and consumables required for every single procedure performed with that robot.
The classic razor and blades model, but with million-dollar razors.
Exactly. A very expensive razor, generating lots of high-margin blade sales over many years. Successfully replicating Mako's dominance in knees, where it's already used in something like nearly 2/3 of all U.S. total knee procedures. If they can replicate that level of penetration in the equally large, perhaps even larger spine and shoulder markets, well, that would fuel significant growth for the next decade, potentially even two and beyond. This expansion is the core growth catalyst the market is betting on.
Okay, so the future growth hinges heavily on Mako's continued expansion. But even the best companies, as we know, have genuine long-term risks. What are the real threats out there that could potentially permanently impair Stryker's earning power, even with all these strengths we've discussed? What keeps management up at night?
That's right. No company's immune to risk. There are a few significant ones, and they're definitely worth considering seriously, as they could permanently alter the long-term investment thesis if they materialize. The most significant emerging threat, the one getting a lot of attention lately, is what we can call therapeutic disruption. Specifically the potential impact of GLP-1 drugs.
Right, the weight loss drugs like Ozempic and Wegovy.
Yeah.
How do they impact Stryker?
Well, the link is obesity. Obesity is a primary causal factor for osteoarthritis, which, as we discussed, is the leading driver of demand for knee and hip replacement surgeries, a huge part of Stryker's orthopedics business. So the widespread, rapid adoption of these highly effective GLP-1 agonist drugs for weight loss could, theoretically, lead to a permanent structural reduction in the overall obese population over time.
Fewer obese people means fewer worn-out joints.
That's the potential long-term implication. It could lead to a corresponding structural decline in the number of joint replacement procedures performed annually. That would directly impair growth and profitability in Stryker's largest and historically most profitable business segment, orthopedics. Now, the timing and magnitude are hotly debated, and it might take decades to fully play out, but it's a profound systemic risk to their core market. Another significant risk is the potential for a major M&A integration failure. As we've highlighted, Stryker's growth model heavily depends on its ability not just to acquire large companies, but to successfully integrate them into the mothership.
Integration is always the hard part.
Always. A catastrophic failure to integrate a multi-billion-dollar deal, think the $4 billion Wright medical acquisition, or the pending $4.9 billion Inari medical deal, represents a major risk. Such a failure could result in massive goodwill and asset write-downs hitting their balance sheet, severe operational disruptions that cripple existing businesses or the newly acquired one, prolonged management distraction pulling focus away from core operations, and potentially a damaged balance sheet that limits future strategic moves. Any of those outcomes could permanently impair shareholder value. They have a good track record, but the risk is always there with big deals. And finally, there's the ever-present risk of a significant U.S. healthcare system overhaul. Since the U.S. market accounts for approximately 75% of Stryker's total global sales, the company is highly exposed to changes in U.S. healthcare policy.
Huge concentration in the U.S. market.
Massive. A fundamental shift in the system, maybe a move towards a single-payer model, or the implementation of aggressive government-mandated price controls, specifically targeting medical devices, could permanently compress Stryker's historically high profit margins. This wouldn't just hurt profits directly, it would also reduce their capacity to fund the vital R&D and strategic M&A that fuel their innovative edge and maintain their competitive advantages. So a major policy shift could indirectly erode its long-term moat and profitability over time.
Okay, those are some significant risks to track. Let's try to apply some second-level thinking here now, as we like to do. What's the general market consensus on Stryker right now? What's the prevailing narrative? And where might our deeper analysis differ, perhaps leading to an aha moment for us or for the listener looking beyond the surface?
Right. Stepping back. The prevailing market narrative and the Wall Street consensus on Stryker is, as we've touched upon, overwhelmingly positive. It's widely regarded as a best-in-class medtech compounder, a blue chip in its sector. Everyone acknowledges it has a formidable and undeniably widening moat, especially driven by the success and expansion potential of its Mako platform. Analysts are broadly bullish, reflected in a strong consensus buy rating on the stock. Most believe the premium valuation, while high, is largely justified by its consistent operational execution, its quality, and its clear runway for future growth. There's not a lot of debate on the quality of the business itself.
So the market generally loves it and thinks it's worth the price.
Pretty much, yeah.
Oh.
That seems to be the consensus view. However, a deeper, maybe second-level analysis could suggest that the market, while appreciating Mako, might still be underestimating the compounding power of the Mako ecosystem as it scales across multiple surgical specialties.
Underestimating the ecosystem effect. How so?
Well, the value creation here might not just be additive. It could be genuinely multiplicative. The market often tends to view Mako for knees, Mako for hips, and the forthcoming Mako for spine and shoulder applications as distinct separate growth drivers. They sort of value them individually, as if they were just different product lines adding up. But a more insightful view, perhaps, recognizes that with each new Mako application added to the platform, the value of the underlying platform itself to the hospital increases almost exponentially, not just linearly.
How does that exponential effect work?
Think about it. A hospital that is invested in and fully integrated Mako for knee procedures, hip procedures, and spine procedures is far, far less likely to switch any of those product lines to a competitor than a hospital that's only using the Mako robot for a single application, like just knees. The switching costs multiply. This platformization of the operating room creates powerful reinforcing effects. It offers significant operational leverage for the hospital. They have one core robotic system, one training protocol, one service contract for multiple high-volume uses, which is incredibly efficient. It generates a powerful data network effect. More procedures across more anatomies generate more data, which in turn refines and improves Mako's AI algorithms, making the system even smarter, more precise, and more valuable over time. And most importantly, as we discussed, it leads to deeper and deeper institutional integration with hospital workflows, their IT systems, and even their strategic planning at the C-suite level. They become utterly reliant on the platform.
So the whole becomes much greater than the sum of its parts.
Exactly. That's the potential aha moment. This suggests the market may be underappreciating Stryker's potential for a true winner-take-most, or maybe even winner-take-all dynamic in the future of orthopedic robotic surgery. If that's true, then the long-term growth runway and the ultimate durability of its moat may be even greater than currently reflected in its already demanding stock price. It implies the premium might be justified if this ecosystem effect truly plays out.
That's a fascinating counterpoint to the valuation concern. Okay, we've explored the bull case, the strengths, the growth drivers, and we've looked at the bear case, the risks, the valuation concerns. Now for the ultimate red team challenge, this is where we really try to break the thesis. To truly understand the risks, we have to ask ourselves, how could an investment in this clearly wonderful company at today's elevated price become a major long-term mistake for us as investors? What's the scenario where this goes badly wrong?
Right, the stress test. The most compelling argument, I think, for a truly catastrophic investment outcome from today's price level rests on the simultaneous failure of the primary growth engine, A&E, the acceleration of the primary risk. It's not just one thing going wrong. It's the dreaded double whammy scenario where the future disappoints and the present erodes. That's what could truly damage an investment made at a high multiple.
Okay, walk us through that nightmare scenario for an investor. Paint the picture of how that double whammy unfolds.
Okay, let's imagine this grim scenario playing out over the next 5 to 10 years. The entire bull case for Stryker's future growth, the narrative justifying that 50-plus PE ratio, is heavily predicated on Mako successfully expanding into spine and shoulder surgery, replicating the near-total dominance it achieved in knees and hips. In this nightmare scenario, Mako fails to achieve that same level of market penetration and commercial success in these new, arguably more complex anatomical areas. Perhaps it's due to greater technical challenges in spine surgery, or maybe different competitive dynamics emerge with specialized spine companies fighting back harder, or maybe even surgeon resistance in those fields is higher than anticipated.
Whatever the reason, the primary growth engine sputters. It just doesn't fire as expected. Those anticipated new, high-margin revenue streams from Mako Spine and Mako Shoulder don't materialize as robustly as the market currently expects.
So the future growth driver stalls out. What's the second part of the whammy?
Simultaneously, imagine the primary bear case we discussed. The impact of the GLP-1 weight loss drugs materializes much faster and more severely than anyone currently anticipates. Instead of a slow, gradual impact over decades, maybe adoption is rapid, efficacy is high, and adherence is strong, leading to a quicker, more pronounced structural decline in demand for primary joint replacement procedures, particularly knees and hips. So picture this. While the anticipated new growth engine, Mako expansion, fails to meaningfully kick in, the existing legacy engine, the core orthopedics joint replacement business, begins to structurally erode faster than expected due to a shrinking addressable patient pool.
Ouch! New growth fails. Old core shrinks.
It's exactly. The devastating result of this double blow is profound for the investment thesis. The company's entire growth narrative would effectively collapse. Its overall growth rate would decelerate sharply from the expected double digits, which were needed to justify its current valuation, down towards a sluggish, low single-digit, perhaps even just GDP-like growth rate. An investor who paid a premium PE multiple of over 50 times earnings for a business whose growth profile has suddenly, fundamentally downshifted would face a painful and almost certainly permanent loss of capital. This loss wouldn't likely come from bankruptcy. Stryker's too strong for that. It would come from a severe and entirely justified compression of its valuation multiple, as the market brutally re-rates it from a high-growth compounder to just a slow-growth, mature healthcare business.
So the multiple shrinks drastically.
Drastically. It's the classic wonderful company bought at a terrible price mistake, amplified by a negative turn in fundamentals. The combination of a failed future growth catalyst and an unexpectedly eroding base business is the most potent argument for why an investment made in Stryker today, at these levels, could become a significant long-term failure despite the company's obvious quality. That's the Red Team Challenge outcome.
Wow. Okay, we have covered a lot of ground today. We've just taken a truly comprehensive look at Stryker Corporation. We've uncovered its undeniable, enduring business quality, the formidable power of its Mako-driven moat, which seems to be widening, the disciplined approach of its long-tenured management team, and its robust financial foundation. It checks a lot of quality boxes. Now, the central dilemma, the question left for you, the listener, to ponder as a potential investor is this. How do you weigh that undeniable quality, those powerful long-term secular tailwinds like aging demographics benefiting Stryker, against its current, quite demanding valuation and the potential for that double whammy risk scenario we just laid out, the growth stalling while the core erodes? What truly defines a safe or a wise investment for you personally? Is it solely about the underlying quality of the business itself, finding the best company regardless of price? Or is the price you pay for that quality an equally critical, perhaps even more critical factor in your long-term success? The deeper you look, the more nuanced, and I think the more fascinating the picture becomes. It's certainly a lot to think about. Thank you for joining us for this deep dive into Stryker.